I want to tell you something that took me way too long to figure out. There is no shortage of money advice in 2026. None. I can open any app on my phone right now and find 17 different people telling me 17 different ways to get rich. And most of that advice is not wrong exactly. It is just incomplete. It gives you a rule without giving you the reason behind the rule. And when you do not understand the reason, the rule stops working the moment life gets complicated, which it always does. So today I am not just going to give you 5 money rules. I am going to sit down with you and actually explain why each one works, what happens to real people when they ignore it, and how the rule needs to be applied differently in 2026 compared to what your parents were told. Because the fundamentals of personal finance are mostly the same as they have always been. But the world those fundamentals have to operate in has changed significantly, and pretending otherwise is doing you a disservice. I have been studying money psychology and financial behavior for years now, and the thing that keeps striking me is how simple the rules actually are. Not easy, simple, there is a difference. And by the end of this video, I think you are going to feel that difference in a way that actually sticks. If this is your first time here, hit subscribe right now because this is exactly what I do on this channel every single week. I break down money, markets, and financial psychology in plain language without anyone telling me what I can and cannot say. All right, let us get into it. Rule number 1, pay yourself first, and I mean actually first. I know you have heard this before, I know, but I want to ask you something honest. Are you actually doing it? Because there is a version of paying yourself first that most people do, which is not really paying yourself first at all. What most people do is they get their paycheck, they pay their rent, they pay their bills, they buy their groceries, they get through the month, and then whatever is left over at the end they maybe save, if there is anything left, which there usually is not. That is paying yourself last, and it does not work. I tried it for years, and I can tell you from personal experience that the money always finds somewhere to go before it gets to savings. Paying yourself first means the moment your paycheck hits your account, a predetermined amount moves automatically to a savings or investment account before you touch a single dollar for anything else. Not after rent, not after groceries, before everything. The savings move happens first and then you live on what remains. The reason this works is not financial, it is psychological. When I set up an automatic transfer for the day after my paycheck arrives, I stop thinking of that money as mine to spend. It is already gone. My brain adjusts to the smaller number and I figure out how to live on it. When I tried to save what was left over, my brain always found a reason why this particular month was an exception. Now here is the 2026 twist on this rule. The where matters as much as the when. In a world where high-yield savings accounts are offering real returns again after years of near-zero interest rates, parking your pay-yourself-first money in a traditional savings account earning 0.01% is leaving real money on the table. I personally keep my emergency fund and short-term savings in a high-yield savings account. The difference in annual interest compared to a standard bank savings account is not life-changing on small balances, but the habit of optimizing where your money sits is a muscle worth building early. Start with whatever percentage you can. If you can do 20%, do 20%. If right now all you can do is 5%, do 5% and automate it today before this video ends. The percentage matters less than the habit, and the habit matters less than the automation. Remove the decision from the equation entirely. Rule number 2, your net worth is not your income. Stop confusing them. This one genuinely bothers me when I see people fall into this trap, and I see it constantly. I have watched people earning $90,000 a year who are genuinely financially fragile, one unexpected expense away from real trouble. And I have watched people earning $45,000 a year who are quietly building something real. The difference is never the income. The difference is always the gap between what comes in and what gets kept. Net worth is assets minus liabilities, what you own minus what you owe. In that number, not your salary, not your title, not your apartment or your car, is the actual scoreboard of your financial life. I track mine every single month. It takes me about 10 minutes and it is the single most clarifying financial habit I have. Here is why this matters so much right now in 2026 specifically. We just came through one of the most aggressive inflation periods in 40 years, followed by a high interest rate environment that made debt significantly more expensive than it was for most of the previous decade. The people who went into that period carrying a lot of high interest debt, credit cards, variable rate loans, they felt that shift in a very personal way. The people who had been quietly building their net worth by keeping liabilities low were far more insulated. Debt at high interest rates is a net worth destroyer. Every dollar you owe at 22% credit card interest needs to earn 22% just to break even. I'm not earning 22% anywhere in my portfolio. Neither are you, so the most guaranteed high return investment available to most early stage people right now is paying off high interest debt. Not glamorous, not the kind of thing that gets likes on social media. But mathematically, it is often the highest returning thing I can do with a dollar. Track your net worth, know the number, let the number guide your decisions more than your income does. Rule number 3. Build a real emergency fund before you invest a single dollar in the market. I know this is the one that is going to frustrate some of you because you want to be in the market. I understand that. I felt the exact same impatience when I was starting out, but hear me out on this because I have watched this mistake destroy real people's long-term financial progress. An emergency fund is 3 to 6 months of your essential living expenses sitting in cash or a high-yield savings account that you do not touch for anything except a genuine emergency. Job loss, medical situation, major unexpected repair, that is it. Here is what happens when you invest without an emergency fund. The market drops, which it does regularly, it always has and it always will. At the same exact moment the market drops, something in your life goes wrong because that is how life works. You need $3,000 you do not have in cash, so you sell investments at the worst possible time during a downturn, locking in losses that you would have fully recovered from if you had just been able to wait. The emergency fund is not just about the emergency. It is what allows you to stay invested through market volatility without being forced to sell. I think about my emergency fund the way I think about insurance. I do not hope to use it. I am genuinely glad when I do not use it. But the peace of mind it gives me changes how I make every other financial decision. When I know I have a real cushion, I can afford to be patient with my investments. Patience is the most valuable investing skill there is, and a fully funded emergency fund is what buys me that patience. The 2026 update here is that with high-yield savings accounts now paying meaningful interest, your emergency fund does not just sit there dead anymore. Mine is earning something real while it waits. That removes the last psychological resistance I used to feel about having money sitting in cash. It is not sitting dead. It is sitting ready and earning while it waits. Rule number 4. Invest consistently in boring things and stop trying to be clever. This one is the hardest for me personally to follow because I find markets genuinely fascinating and fascinating things tempt me to act. But the data on this is so overwhelming that I have had to train myself to embrace boring as a feature, not a bug. The research on individual investor returns is humbling. The average individual investor consistently underperforms the index they are trying to beat, not because they are unintelligent, because they buy high when things feel exciting and sell low when things feel scary, because they chase performance, because they try to time the market, because they get caught up in narratives, exactly the Keen's beauty contest problem I talk about in my stock market video, and they make emotional decisions with money that demands patient decisions. The boring alternative is a low-cost S&P 500 index fund bought consistently every single month regardless of what the market is doing. This is called dollar-cost averaging, and what it does is remove my emotions from the equation. When the market is down, my automatic investment buys more shares at lower prices. When the market is up, my investment buys fewer shares at higher prices. Over time, through up markets and down markets, through inflation scares and AI booms and whatever comes next, the consistent investor who stayed boring consistently beats the clever investor who kept trying to outsmart the room. Now here is the 2026 nuance I want to add to this rule because I think it matters. The S&P 500 right now is more concentrated in a handful of companies than it has been in modern history. The Magnificent Seven tech companies make up over 30% of the entire index. That is not necessarily a reason to avoid index funds. It is a reason to be aware of what you actually own and potentially to consider some additional diversification into international index funds or small-cap index funds alongside your core S&P 500 position. I am not saying abandon the boring strategy. I am saying understand what boring means in 2026 specifically, because the composition of the index you are buying has shifted meaningfully from what it was even 5 years ago. The principle remains exactly the same. The implementation deserves a slightly more informed eye. Also, on the topic of being consistent and not clever, I want to say something about crypto because I know it is on a lot of people's minds right now, and I am not going to pretend it is not. I have a small allocation to crypto in my overall portfolio. Small. Like genuinely small. I treat it as a high-risk speculative position, not as a savings vehicle and not as my investment strategy. If you are in the early stage of building your financial foundation, putting significant money into crypto before you have your emergency fund, before you are consistently investing in index funds, before your high-interest debt is handled, that is the wrong order of operations in my view. Get the foundation right first. Then if you want to speculate with money you can genuinely afford to lose, that is a conversation worth having, but foundation first. Rule number 5, protect your income like it is your most valuable financial asset, because right now it is. This is the rule I see get skipped most often by people in the early stage of their financial journey, and I think it is because it is not as intellectually interesting as investing or net worth tracking. But I want you to really hear this. Your ability to earn income is the engine of everything else in this list. The emergency fund gets funded by your income. The investments get funded by your income. The debt gets paid down by your income. If something happens to your income and you have not protected it, every other financial plan falls apart simultaneously. Protecting your income in 2026 means several things to me. First, it means having the right insurance. Disability insurance specifically. If you cannot work for 6 months or a year due to illness or injury, what happens? Most people have not thought about this seriously, and most people are seriously underprotected. If your employer offers disability insurance as a benefit, I genuinely urge you to check right now whether you are enrolled and what it covers. If you are self-employed, this conversation is even more urgent. Second, it means investing in your own skills consistently. The job market of 2026 is not the job market of 2016. AI is genuinely changing which skills are valuable and which are becoming commoditized. I spend real time and real money every year keeping my skills current and building new ones. That investment in myself has returned more to my earning power than almost any financial investment I have made. Your income is not fixed. It is a variable that you can actively influence. And the single most reliable way to increase your long-term net worth is to increase the income side of the equation while keeping the expense side disciplined. Third, and this one is more psychological than financial, protect your income by protecting your health. I know this sounds like it belongs in a wellness video, but I want to say it here because the financial consequences of ignoring your health are real and they are severe. Medical debt is still one of the leading causes of financial hardship for American families. The hours I spend sleeping adequately, exercising, and managing stress are not hours stolen from productivity. They are investments in my most important income-generating asset, which is my ability to show up and perform. Your income is not just a number on your paycheck. It is the foundation everything else sits on. Treat it that way. Alright, let me bring this all together because I want to make sure these 5 rules land as a connected system and not just 5 separate pieces of advice. Rule 1, pay yourself first automatically creates the savings habit. Rule 2, track net worth not income gives you the honest scoreboard. Rule 3, build your emergency fund first gives you the stability to stay invested through volatility. Rule 4, invest consistently in boring things builds your long-term wealth without letting your emotions destroy it. Rule 5, protect your income keeps the engine of everything else running. These 5 rules are not complicated. I want to be honest with you about that. None of this is secret knowledge. None of it requires a finance degree or a special brokerage account or a specific income level to start. What it requires is consistency and the willingness to prioritize the boring right thing over the exciting wrong thing, which is genuinely harder than it sounds in a world designed to make you spend, consume, and react in real time. I have made every mistake on this list personally. I have saved what was left over instead of first. I have confused earning well with being financially healthy. I have invested money I needed for emergencies and been forced to sell at the wrong time. I have tried to be clever instead of consistent, and I have underestimated how much my earning power was worth protecting. Every single lesson in this video cost me something real before I learned it. My hope is that by telling you the lesson directly, I can save you at least some of that cost. If this connected with you, share this video with one person in your life who you think needs to hear it. And subscribe right now because every week on this channel I am sitting down with you to work through exactly this kind of thing. No fluff, no nonsense, just the honest financial conversation I wish I had found earlier. This is Dave. I will see you in the next one.